Welcome to SRG Offscript, podcast where experts at Succession Resource Group unpack the latest industry trends, recommendations, and observations for independent advisors managing their practice. No fluff and a little entertainment. In each episode, we'll discuss ways in which you can understand and leverage the value of your business, grow your business through M&A, but also through an optimized organizational structure, improve and protect your business to create a sustainable enterprise that can hopefully outlast you, and lastly, preparing for your eventual retirement and how to maximize that result. So, we encourage you to listen in with whatever beverage suits your preference, and let's get to the forefront of industry trends with a fresh perspective to help you achieve your business goals. Welcome to another episode of SRG Offscript. Today I'm going to talk about a very specific topic that frankly doesn't get nearly as much time and attention as it probably deserves. It's also not the most exciting subject matter, and that is death and disability planning for you as an independent advisor, for all of us as small business owners. So I want to start by bifurcating the subject because we do a lot of work around contingency planning for advisors, creating a plan for the unexpected. We also do a lot of work around succession planning, which is very much planning for the expected, retirement planning. Those can sometimes be the same solution. It may even end up being the same contract, same parties, but not always. And so I think it's worth pulling those two subjects apart and potentially tackling them in their component pieces. So succession planning, again, focused on the long-term development of talent internally, looking at maybe a merger or external sale. It is the eventual exit strategy. It's the planning that leads up to that exit strategy. But again, the idea here is that succession planning by design is kind of the vertical exit, as opposed to contingency or continuity planning, as it's sometimes referred to, is more about the unexpected, the horizontal exit. So the reason I say they could be the same, they could be different, is I do see a lot of advisors that I've talked to over the years attempting to tackle both of those things as one big project, eventually as one big contract with one individual or one team. And that can work, but it almost makes it into, it's too much. And frankly, sometimes dividing and conquering can just be easier, especially in a case like this. So, for example, if you had an amazing internal team, or maybe you got a son or daughter on your team, the long-term plan is for them, him or her, to eventually take over. But if you looked at it short-term, like immediate today, you go out to lunch and you don't come back, they might not be the ideal immediate short-term solution, as in like they're just not ready. So that's a good example where we could acknowledge that with time in the saddle, working alongside you, a couple more years of mentorship and training, they very likely will take this firm over. Like it's theirs to lose. But they don't have the experience of running a firm yet. They're just not there. Not that they can't, but they haven't. And so it's common in cases like that, especially with internal succession planning, where the mentoring and training is happening, or family members and those things are happening, to start with a short-term disaster plan, death and disability, maybe loss of license, with an outside entity. If you're an RIA with another peer in the industry, if you're under an IBD or a hybrid setup, somebody on the same network, try to make it as turnkey as you can, but it's with a third party, somebody outside your organization. As an immediate Band-Aid, that can be nice because they obviously, like your internal team, know how to service clients. Now, your internal team is going to have an edge on them from the client service perspective because your internal team knows how to service clients your way. The external team will know how to service clients, but maybe not exactly how you do it. But what the outside organization does have as a short-term benefit is they know how to run a business. And so if something happened and they got that phone call and they had to be there, they've run a business before. They know how to do it. And so that combined with also their expertise and experience as a fellow advisor can make a really good short-term solution. So understand it could be that your team is ready and you just do your contingency plan with your existing partners, with your internal team members. If they're not quite there yet, just divide and conquer. Start with a plan with an external individual, and then we'll get to talking about the contract later. But when you set that contract up with us, for example, We'll make sure that the contract exists for maybe 2 or 3 years initially, and then it becomes annually renewable thereafter, giving you the opportunity in a few years to pivot if you need to. So you're not locked in forever, but be careful because I have definitely seen cases where folks work with local counsel, and to make sure that their plan never lapses, they have the plan effectively go into perpetuity, and then it's cancelable by mutual consent, which can be problematic. So that's my initial fork in the road: is tackle succession separate from contingency. If you can do both, fantastic. If you can do both with the same person, even better, but don't get hung up on that. So why does it ultimately matter? Why focus time and effort on the death, the disability, knowing full well that most of us will never deal with this, and certainly never expect to deal with it, or never want to? I mean, it comes back to the thing here that has value in a professional service business, and that is the clients and the relationships, but also then the staff that delivers on that experience, your family. I mean, the death and disability plan, yes, it is functionally about making sure the business gets transferred, value received, but it does even more than that. I mean, having worked in instances over the years where we've gotten that phone call and there is no plan in place, it's really tough when you're dealing with, a spouse, you're dealing with an estate, kids, and they've just, lost their husband, their wife, they've lost their mom or dad. I mean, it's impactful on all the key stakeholders, obviously. But then when they also have to deal with these business related matters, I mean, it's painful to watch. And frankly, it's tough because in a professional service business, the value here is in the client relationship. And that was with the recently deceased advisor or team. I mean, it can go up in smoke very quickly if we don't have a solution in place expeditiously. And that's hard to do when you're making funeral arrangements, or I mean, that's frankly almost best case scenario. If you're dealing with somebody who's now permanently disabled, I mean, it's just a lot. So if we can try to get this stuff done ahead of time and then knock on wood, never need to use it, kind of like insurance, that's a lot better than the alternative. It also comes down to then what type of agreements do folks use? And that is in large part dependent on, as you sit here listening to the podcast today, who are you? And by that, I mean, on the more technical side, are you an independent RIA? Are you a rep under a corporate RIA, an independent broker dealer? Those solutions are going to be a little bit different. If you are a partner in an existing organization, you got you and two other partners, you still need an agreement for sure, but the type of agreement that you need is going to be different. So as you look at partners, for example, where you got two or more owners, there we're generally going to be focused on either a partnership agreement, like maybe an LLC buy-sell agreement. Sometimes it's baked into the LLC operating agreement. I wouldn't advise it, but I've seen it before. You could end up with a cross purchase, potentially between the partners. If we don't want the company to be involved, we can deal with the individual members or shareholders. You have shareholder agreements if you're an S Corp as opposed to an LLC. And then again, you've got those that are reps and RIAs, which is, a whole nother consideration versus the partners and sole proprietors. So there's just a lot to consider here initially and making sure we get the right stuff. So to unpack this in more detail and try to make it digestible as possible for those of you listening, and maybe you're out for a run, you're on the Peloton, you're driving in your car, let's give you some bite-sized pieces and takeaways here. So I would say when you look at contingency planning, whether you haven't done this yet or you have already done it and we just want to dust it off and revisit it, make sure we're good. 6 core areas, topics that I would focus on. Number 1, what is being sold? And that goes back to my earlier comment about, are you an RIA? Are you under a corporate RIA? Are you a rep with a broker dealer? Do you have partners? That's going to dictate ultimately what is being sold. So you've got what is being sold. Surprisingly, I see that screwed up. I mean, there's not a lot of folks who have these plans in place, but those that do, oftentimes, either the attorney writing it up didn't know what to ask, or the advisor asking for it didn't know how to articulate it clear enough to an attorney who doesn't know the industry well enough. So you got what is being sold. You have what are the triggers? I mean, death is the most common one. You've got permanent disability, temporary disability, maybe loss of license, and occasionally retirement. So that's your menu of choices. We also then have, what's the level of commitment of the other party, the buyer or the future buyer? Are they just committing to make an offer? Are they committing that they get the first right to make the offer? Or are they committing to actually buy the business if something happens to you? So that is definitely something we want to unpack in more detail here. It sounds simple, and it can be. But again, it's an area where there is some optionality, and your preferences as the business owner wanting a plan might not be the same as the person you're trying to put the plan in place with. So you've got what is being sold. We need to define that. We'll come back to that. We have what are the potential triggers: death, disability, permanent or temporary, loss of license, retirement, the things we talked about. We also then have kind of the mechanical pieces of a plan like this to make it turnkey. And that is price. How do we get to a price? What are the payment terms? And then how's it taxed? So those are our 6. So let's unpack each of those here individually. We've got number 1, what's actually being sold? Who are the parties on the agreement? What's actually getting transferred? So this gets into some kind of technical matters, but it matters. So let's examine it here to make sure when you do your plan. I mean, if you do it with us, obviously our team of experts will make sure we get this right for you because it's what we do. And the benefit for us is, we use form contracts that have been evolved over the years. So it's more about us understanding your situation so we can make sure that you get the right contract. But that's not always the case. So initially, let's start with an RIA. If you're listening today, you're largely fee-based or you're a fee-only RIA, you have your own independent RIA. Then as you think about putting together a plan, it seems pretty simple. Like, if I'm going to be your contingency partner, I would buy your RIA. If I'm internal to the organization, yes, more than likely, I'm buying the RIA. I want it to stay intact. I want as little disruption as possible. But again, that isn't always the case. What if I was an external peer and I'm agreeing to put a plan in place to buy your business in case you die or become disabled? If I'm your peer, I already have an RIA. The last thing that I need is 2 RIAs, 2 compliance manuals to upkeep. I don't need it. Now, inversely, the RIA has the contract with the clients, and that I do need if something happens to you. So it wouldn't be crazy to make sure that we do include in the actual stock or membership interest in the RIA as the thing that your buyer eventually buys. Downside is, as you flip to the buy side, I guarantee their attorney is going to tell him or her, well, don't buy stock in a company if you can avoid it, because you get all the good stuff, but you also potentially get the bad stuff that you didn't even know about. So they'll oftentimes be a little gun shy, even if you've got a great compliance record. The attorneys they're really good at making sure they mitigate the risk of their clients, which unfortunately can sometimes mean causing, more potential risk, because buying the RIA is undoubtedly the easiest of the solutions. So your choices as an RIA, you can sell the equity in the RIA. Now, again, you're still dealing with change of control issues if something happens and you pass. So we still have to notify the clients, but you're going to do that anyway. It's more about then not having to have them sign all new investment advisory contracts because I bought the company that they have the investment advisory contract with. Alternatively, you could structure the buy-sell, and we do this a lot. You could structure it as an asset purchase, where when something happens and there's a triggering event, you and or the RIA are selling the client relationships and rights to future revenues to whoever this buyer is. Now, it's certainly cleaner. It's a little bit better from a tax perspective for the buyer, because when they buy goodwill, they can amortize that over 15 years versus buying your RIA where they get basis. So there's pros and cons to either of those strategies. The downside to them as a buyer, not doing an equity sale and buying the RIA itself, but buying the assets from the RIA, is we're not getting the client contracts because those aren't transferable. And therefore, we have the advisor pass away A letter goes out, generally speaking, notifying the clients about what's happened, what the plan is. Then you reach out, but you have to get them to sign new investment advisory contracts with your firm before anything can happen. Now, generally, if we're all good about planning and communicating to the clients ahead of time and going through the fire drill, we will probably be okay. But you will likely have some loss of clients. You'll have some breakage in there. So that's the RIA space. You can do the equity sale, certainly the merits there, especially when you talk about death and disability and mitigating risk. You could also do the asset sale. If you're operating under, let's say, an independent broker-dealer or general agency, there generally what you have to buy and sell is the client relationship and rights to future revenues. Now, again, the nice thing is most of your book of business at this point, industry-wide, is pretty annuitized. And by that, I just mean consistent, predictable, and recurring. Whether it's fees, trails, 12B1s, insurance renewals, financial planning that you charge for and do consistently, all of it's pretty predictable. So in those cases, if you're under an IBD, you're getting paid individually. Most of the time, you're going to be doing an asset sale, some form of buy sell, but the thing being bought and sold is an asset. It's the client relationship, some rights to future revenues. But there are some limited instances where some of these teams under the IBD or corporate RIA, they get big enough where, they have 20, 30 staff. They have great systems and processes. They have a 401k, other employee benefits like healthcare, payroll's all set up. They've had QuickBooks for years. There's a legitimate reason, even though they're a sole proprietor operating under the IBD and corporate RIA, they look a lot like a legitimate business, and they're doing 10, 15 million a year in revenue or more. So even in cases like that, there actually can be a case made where we probably should plan to do an asset sale and equity sale. Not that there's a ton of value in the LLC or S Corp in my example, but there is some value. And generally the seller's going to probably have some basis in it. So anyway, the idea of what's being sold as your initial consideration seems obvious, but you can get a little technical in there in our industry and just making sure that we get it right. Because the last thing we want to do is have to leave this to your spouse or your estate. After that, we get to, what are our triggers? And so again, triggers, generally speaking, you got some optionality here, but the core ones I would recommend you hit in your document, certainly if we help you, we'll get there, is death for sure. Permanent disability, as difficult as that is to define, I think we've got a pretty good definition, but it's still tricky. But also, I would make sure we cover temporary disability and potentially loss of license. Now, that one's a little tricky because we don't know the reason that you would have lost your license. It could be totally administrative and just annoying. It could be something, much more egregious where nobody wants to buy the business at that point. So loss of license, it's in probably half the plans that I see our firm producing. Death, disability, temporary and permanent, that one's in there most of the time. And then you even have retirement, potentially. I would generally tackle that separately. But if you're doing a plan with your contingency partner, he or she is going to be your eventual retirement partner, it could make sense to check that box all at once. We have that optionality built into our contract, so it's not crazy that you would do that. So those are your common triggers. And then we get down to, what's their level of commitment? Whether it's an internal partner, those folks are usually much more committed, both practically and technically. You got outside peers. And I see from an outside peer perspective, documents many times that it's just a right to buy. If something happens to me, you have the right to buy my business. That's not great. It's better than nothing for sure, but you'd much rather see a buyer, eventual successor who's committed. If I die or become permanently disabled, if I'm out of commission, I know you're going to take my business over. You know you're going to take my business over. More importantly, we tell the clients, here's the fire drill. I'm healthy, no issues, but I eat my own cooking. I'm being proactive. I have a plan. Here's what that plan is. But you're not going to do that if your contingency partner just has the right to buy your business because they might not buy it, and we might be left trying to figure out who's going to buy it. So the level of commitment, initially, it sounds nice to just give somebody the option to buy it. We need something much more turnkey in a perfect world. Because again, if you're gone suddenly, we want to make sure your clients get taken care of. We don't have a ton of lead time here. Compliance issues aside, just practically making sure clients get taken care of. God forbid it's a major market correction, something that gives you a heart attack, and then your clients can't get a hold of anybody. So that's the level of commitment as a consideration. Then you start getting into the mechanics of the document. And this is stuff that comes up whether it is a buy-sell between two peers, whether it's an LLC buy-sell agreement or shareholder agreement between partners. We have to get price, terms, and tax structure. So let's start with price. We could acknowledge we're talking death and disability, which by design probably isn't happening today, which means it's happening in the future at some point or never, frankly. So we know we have to hit a moving target. Common ways that we see these documents get prepared in terms of the valuation, setting the price. Academically, you have a stated value. That is an option. It doesn't get used very often. Surprisingly, I used to see it a lot more, where we literally state the value of my business is $1.5 million. It's $1.5 million until we say otherwise, and the plan is updated annually. Downside is not everybody would then come back and update it annually, and the value is what it is until we say otherwise. So stated value is nice because there's no room for interpretation. We said the value is $1.5 million. It's $1.5 million. There's no math to be done. There's no reports to be gathered. So while its downside is it's very static and doesn't change, its upside is it's very static and it doesn't change until we change it, and we can just simply move forward. But you got to be very diligent about coming back and updating it. So I would generally recommend the stated value, but I understand why some of our clients go that route and they just commit and they calendar. Every January, they do our annual valuation program. They get their updated value. They go back and update the document, and now it's $1.7 million until we do next year's valuation. And if we miss it for a year, you know what? Yeah, we left some money on the table, but we still have a plan and it can be quickly implemented. The other two more common alternatives, either A, a formula, or B, we kick the can down the road and we just agree that when there's a trigger, we're going to do evaluation at that time. So pros and cons of each of these two. So formula-based methods for setting the value are nice because if we keep the formula simple, we can hit a moving target. We don't have to come back and update it on an annual basis. We might true up the multiple of EBITDA or of revenue periodically because the multiples do change industry-wide, plus just your practice gets better or worse. But even if we don't update the multiple as regularly as we probably should, we're not going to be too far off the mark, because if your multiple you had plugged in from your most recent valuation is 2.85 and your practice doubles in size, well, it's going to be 2.85 times double the revenue. So you're not going to be too far off, even if really your multiple now should be 2.93. So yes, money left on the table, but you'll certainly, if you set it and forget it, you won't be as far off as you might be with a stated value. The downside of the formula is it is a formula. And I've seen people create some really stupid formulas. I mean, works of art, when you look at them, the downside is, the reason I label it stupid is because I've seen these things try to be implemented and it is a nightmare. You can't get the data. Once you do finally get the data, it can be interpreted 6 different ways to Sunday on how we build that into the formula. And you know who helps sort out the formula if we can't agree? A judge. And that's expensive. So generally it's fine, but there are some potential downsides to the formula, hypothetically. Valuing at the time ensures no matter what happens, if the market is doing great, if the market's doing terrible, the practice has grown a ton, we're never going to miss the mark because we're valuing it at the time in its present condition under the current market conditions. You can't get it wrong at that point. That's the pro. The downside is we have to gather a bunch of data to do the valuation. So it would be important to make sure we had a track record of doing valuations so the team knew where to get the data from, the reports were easily accessible. Like, we know the protocols, we can get the data. Because I tell you, some of the firms we work with, they don't keep great financials, which is fine. They don't need them really until you need them. Or they're under a large corporate broker-dealer or RIA, and the reporting is kind of, dicey to get the level of data needed to do an analysis. So kicking the can down the road and agreeing to do the valuation at the time ensures we get an accurate value, but it's dependent on getting accurate data and doing that in a timely fashion. That would be the downside. So any of these methodologies, though, stated value, formula, valuing at the time of a triggering event, they have to account for the risk. No matter how you slice it, we're talking about death and disability that is less desirable than your retirement. But accounting for risk isn't always done through discounting the price. I mean, it can be as explicit as the stated value formula or valuing at the time less a 10 to 30% discount wouldn't be crazy. Depends on the particular practice, tenure of the clients, nature of the revenue stream. It is also then dependent on the next part I'll talk about, which is the payment terms. So if we get into payment terms, that's another way we can mitigate risk. It's worth breaking down also the fact that we're trying to develop a solution for death and disability. You could fund the death scenario in part or in whole with life insurance. So, there's a chance you could potentially outgrow the life insurance. There's a chance that life insurance policy could lapse. So it can happen. So we generally are going to want a backup plan that if there isn't another funding source, we will do a promissory note. We will agree to make payments out of cash flow over 7 to 10 years is pretty common. 7 to 8 is probably most of the plans, but I see a lot of them that our team is putting together in that 7 to 10 year range. Basically, if something happens, it's unexpected, we don't have life insurance, could just be disability or something that triggered it, or we just don't have enough life insurance. If we have 7 to 10 years and it's accruing interest, I'm going to want to pay it off sooner because I'm a financial advisor. I don't want to pay interest if I can help it. But it also makes sure that the cash flow is in the business to continue it, to pay staff, to grow it. And that's important. I've seen death and disability plans that have one funding mechanism, and it's just a promissory note to pay the seller back in 4 years. That might work, but 4 years at today's multiples can be tricky to try to compress that kind of a payment stream into. You'll be cash flow positive for sure year 5 through 10, but it's years 1 through 4 that I'm concerned about. So be reasonable in the financing terms. Generally, 7 to 8 years is a pretty safe bet to make sure that there's ample cash flow for the business to continue, even if you have a little bit of breakage, some clients that you lose. Life insurance works great. Just know it's a funding mechanism. It's not an actual solution. I do see a lot of folks that we talk to, and we work to fix it for them. But when they start with us, they initially think they have a plan because, all 3 partners or the advisor bought $1 million of life insurance, and that more than covers the value of the practice, and their spouse is the beneficiary. That's great. I'm an advocate of life insurance. There's certainly a place for it. But then we still have to tackle the value of the book of business. So if we're going to use life insurance for the book of business, then the contingency partner needs to be the beneficiary. So they get the money to give to your estate or your spouse to pay for the practice. So with the stepped up basis, it still ends up being generally tax-free in that scenario. But we got to make sure the organizational chart and flow of monies is lined up. So life insurance works great, but I'd still put a backstop in just in case you either outgrow it or the policy lapses, something crazy happens. And then you've got disability, temporary and permanent. If it's permanent disability, however we trigger it, again, that's a whole other podcast, frankly, to unpack that one. But we've got a pretty good definition. So let's say we trigger permanent disability. You're not probably going to have a disability policy that's going to pay a lump sum. It exists, but I haven't seen anybody willing to pay the premiums for it. So we just pivot to the promissory note. We make payments over time out of cash flow to the spouse, to the estate, to whomever. It works. Temporary disability, the idea is you might come back. I mean, the hope is you come back. And so there, it'll either be a revenue share or hourly. Hourly is probably the more common one where I'll back you up. I will support you and I'll bill your estate for the support time that's provided because it may be relatively minimal. If you just finished up client reviews, don't have a lot going on, we need to check in with staff and be available to respond to clients. But the amount of time committed isn't probably quite as much. So it's worth making sure that there's some compensation set up to make sure that if you need it, if you don't already have it internally, that you can have an external partner step in on your behalf in your interim. Again, in the RIA space, you may want to look at, sub-advisor stuff that we can help you with, but it is still really nice, especially if you're on the same custodial platform in the RIA space, that somebody could step in and be you for 2 to 3 months if you needed it. And then again, other triggers, you got loss of license. That was tricky, but it's still worth at least considering. And then you've got retirement. And you may or may not want to tackle retirement in these types of plans. If it's the person you're already going to be doing your retirement plan with, that you're putting the death and disability plan in place with, not a bad idea. Worst case scenario, that could be they get the right to make the first offer. And we don't have to go any further than that. If you want something truly turnkey, then we just build in a separate set of price and terms or a separate formula in terms, because retirement is different, remember? It's lower risk. They're still here. So you can tackle it. If you do want to tackle it in the same document, let's tackle it separate, though, because of the differentiated risk between death and disability. Last one is taxes. So taxes, there's not a lot we have control over, but I point it out as an option because it goes back to what's being bought and sold. If we are buying and selling the equity in the RIA, it's going to be long-term capital gains for the selling side, and you're using after-tax dollars, and you've acquired established basis as the buyer. Most of the time, it's going to end up being an asset sale, selling the client relationships, the Section 197 intangible asset. You, as the buyer, can amortize that over 15 years. Seller gets long-term capital gains. Certainly in disability, also at passing. But again, you probably know from work you do with clients at passing, stepped-up basis, sell for fair market value, in theory, should be tax-free, whether there's life insurance or not. So just make sure you revisit that one, because I do see some agreements that are really just focused, especially at the IBD level, like when the broker-dealer provides the document, where it's a revenue share. Like the BD will pay the unlicensed spouse. Don't do that. It's better than nothing, but only marginally. And if our measuring stick is literally nothing, then that's better. But the revenue share is going to get the proceeds to your spouse as a revenue share. It'll be declining for sure, and it's going to be all ordinary income, which is why I say it's not great. So think about the taxes. And then the last thing I'll leave you with for our session today is post-agreement best practices. Don't put the plan together, even if it's an amazing plan we prepare, and then drop it in the filing cabinet. Do file it. You don't want a messy desk. But go through the fire drill with your clients. Make sure they understand what the plan is, just in case. Assure them there's no health issues, assuming there are no health issues. And last but not least is think about the practical elements. Put together, and we've got a good checklist, we help clients with, but the practical elements, the things on the checklist would be, if you were gone tomorrow, what would somebody need to be you temporarily or permanently, like getting access to get into your office, to get into your computer, your filing cabinet? Can anybody else access the bank accounts and payroll? There's just so much that gets disrupted when you're suddenly out of commission. And especially if you get better and come back 6 months later, it'd be nice to know what you are going to come back to. But that takes both the technical planning, putting together the right contract with the right person, but then the practical elements of making sure you take the steps afterwards to create something that can actually be implemented relatively quickly at a moment's notice. So I think between putting together that plan, that checklist, that file, and then telling all your key stakeholders, clients included, but also your spouse, your CPA, you should be in a pretty good place. So I'll leave you with that. Again, I think everybody listening to this as a small business owner, advisor or not, should have some form of death or disability plan Even if it's something you do on the back of a napkin and revisit later, something is better than nothing. Thank you. And that concludes another episode of SRG Off Script. I hope you found this episode both interesting and valuable. We encourage you to check out our website at successionresource.com, or of course, connect with us on social for the latest happenings at SRG. If you enjoyed today's episode as much as we did recording it, please leave us a review and tell your industry friends about us. Your support helps us continue to bring you the best content possible. The information covered and posted represents the views and opinions of the guest and not necessarily represent the views or opinions of Succession Resource Group. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional advice. Always seek the advice of an expert with any questions you may have. As always, we at SRG stand ready to help when you're ready.